Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Fortinet, the cybersecurity company. It's a very exciting company. It is it's kind of grown significantly over the last quarter and it's really back into a growth mode. We're going to talk about its growth prospects. We're going to talk about one of the blemishes that I find in its prospects. We're going to talk about its very strong free cash flow margin of 49%. Then we're going to talk about its valuation. Also, we'll talk about management's ownership of the stock right here. So I'm just going to jump right in. So the thing that's quite exciting here is that Fortinet put out Q2 results that were up. The revenues were up 30% year over year. So that is not only a very strong performance during the quarter, is meaningfully stronger than the previous year. Also, keep in mind that the company Fortinet hasn't been growing at close to mid-20s for approximately 4 years. So this is a very strong quarter that it just came out of. And what's interesting here, as a management last quarter said, okay, we're gonna stop repurchasing shares as aggressively. We're going to double down on our growth prospects because we believe that we have strong growth prospects. And right away, things seem to be improving. So I think that, it's not really down to what management did last quarter, but it's just overall, this whole space in cybersecurity is really, really hot right now. And in this graph, I wanted to highlight some of the stocks in cybersecurity. So this is the past 3 months, okay? So in the past 3 months, this is not an exhaustive list of all the cybersecurity names, but I just wanted to highlight a general basket of them, okay? So you got in the screen, in the green line, you got Zscaler, then you got up 44% over the last 3 months, you got Fortinet, you got in there, you got CrowdStrike and Palo Alto in that order. And, even if the market has been kind of shaky, particularly if I don't know if you invest in kind of growth names, but particularly in the smaller cap growth names, not exhaustive, not particularly just SPACs, but even small caps generally of companies that have traded for a while, it's been really difficult since March. I mean, things have just been really, really difficult. But cybersecurity, it's just been like crazy. If you've been participating here, this is just great, right? So I believe that with that in mind, it's clearly, I'm always a believer that the market's kind of vaguely right. Value investors typically say, "Oh, the market is always wrong." Now, I think the market's typically kind of generally right, and what I believe is a good opportunity is often to try and get in that space and pay the low valuations that are still around. So I wouldn't really say, okay, I know Zscaler is doing really terrific things, but maybe paying 37 times next year's sales probably is a bit punchy, So anyway, that's what I wanted to discuss. The other thing that I want to talk about is that where Fortinet is positioning itself more aggressively into is network security. So rather than some of the other players that are going after cloud security, they still say, okay, cloud security is growing faster, but we think that network security has a bigger total addressable market. You can see here the red circle in the graph, and it's bigger. It's approximately 3.5 times bigger than cloud security. So taking off some market share here is probably going to pay more dividends down the road. So this past quarter, they just announced the new product, which is called the 100F series, and it's quite interesting because the way that Fortinet is split, so approximately 1/3, kind of a bit more, but approximately 1/3 of its revenues is product revenues, and the other 2/3 is service revenues. And as investors, we've been kind of indoctrinated of late to kind of focus a lot more on service. What's service? What's a high margin service operation? So you can see here in the case of Fortinet, its service business is 86% gross margin, so it's a very, very high gross margins, and that's why investors typically love service business because it's a sticky business model and it's it has high margin. Its product revenue carries just over 60% gross margin, so it's approximately 1,500 basis points lower than its service revenues. So when its service revenues was particularly strong in the quarter. And let me get the figures right. So I think put it out there that it grew approximately 60% in the quarter's product revenues. Investors were kind of like, oh, not that excited, because you were thinking, okay, it's not going to be something that is sticky. So it did add a lot of interest to investors, but it wasn't. So here are the figures. So the product revenues were up 41% year over year, whereas the service was only up 24%. So investors, have been indoctrinated to think about the services being always a crown jewel. So the fact that product revenue, which is a smaller part of the business, was up significantly, investors are kind of like, it's low margin, it's not that interesting. So that's one negative aspect, but I think that, that's really just something. And I think that on the other side of the equation, you can see that billings here, I don't know if you can see, but billings were up 35% year over year in the quarter. So with that in mind, it's the strongest billings for quite some time. So it's clearly that, billings are a forward indication of where the company is going to book its revenues over time. So billings is typically cash the company gets up front, and it will get recognized over a period of time. So billings are quite strong, and they've been picking up, and it's the strongest it's been for several quarters. So I think, it really shows that the company is back into growth mode, and I think that's quite exciting. Another very exciting thing about the company here is that you can see in this graph here, the free cash flow is just going up and to the right. That's exactly what you want to see as a shareholder. As a shareholder, you really want to see that your business is growing stronger, more free cash flow over time, and that's just what you're seeing right there. And what I find quite interesting is that if you look back over the past 6 months, only 100 million has been stock-based compensation. So over the past 6 months, only 14% of its free cash flow is stock-based compensation that has been added back. So what you see is really what you get as a shareholder, which is quite rare in cybersecurity, because normally such a large percentage of the free cash flow is just stock-based compensation that will get diluted out over time. So that's really, really exciting. And another point to keep in mind is that 49% of its free cash flow margin is 49% free cash flow margins during the quarter. So during Q2, it's nearly, for every dollar that's come in the revenues, nearly 50 cents has come out as free cash flow. That's it's a business that, yes, it is product based, but I mean, it's like, wow, this company is really, really making a lot of free cash flow. And when I covered Fortinet about 2 months ago, and I was quite bullish on the company, I said, okay, the company noted that they're going to take their foot off the accelerator in terms of repurchasing shares and going back into growth mode. And you can see here there's a slight uptick in the number of shares outstanding. You can see that, obviously there is some stock-based compensation getting diluted out, and that's why the numbers gone back up. But I mean, investors have been pretty much vindicated, because the revenues have really kind of taken off, and the multiple that investors are willing to pay for the stock is also going to continue to expand. And you can see this already taking place. And that's the thing, when you align yourself with management that has strong insider ownership, you can see in the graph the two brothers, the billionaire brothers, have just under 19% of the stock. So they're really motivated to drive shareholder value over time. So when you align yourself with a company that's not just some kind of executive that's come in and kind of trying to make the next several quarters meet, and then they go on to the next operation, when you have management that kind of founded the business and really motivated to see their little baby grow, I think that's why you want to align yourself where possible. Pick out the best businesses. Don't go into kind of long shots that become no shots. Really kind of position yourself into businesses that, when management is very much motivated to drive share price higher over time. And just to add some final thoughts here, so the stock is priced at approximately 14 times next year's sales. So it's kind of like fairly valued on the one hand, but on the other hand, we talked about the fact that it has free cash flow margins of 49%. So I mean, this is really, really attractive. Again, if you look at the rest of the space, you got Zscaler, the cybersecurity company, that's priced at 37 times next year's sales. So paying 14 times is like a bargain in comparison. The crowd favorite, CrowdStrike, that's obviously still growing really, really fast, is priced at 21 times next year's sales. So you got these companies that are just valued very, very highly, because the space is very, very high. On the cheaper side of the spectrum, you got FireEye. They've divested. I've followed them before, and they're divesting of their products business. So it's quite an interesting thing that whereas Fortinet is doubling down on their products business. FireEye's actually said, okay, we want to get rid of this products business. Yes, it does make a lot of cash for us, but we're gonna just sell our business. And now 25% of FireEye's business market cap is actually made up of cash, and the stock is priced at 8 times forward sales. So it's probably one of the cheapest fire security companies you can see out there. So I mean, with all that, I think, you know, there's a lot here to be bullish about the company. It's not a stock that I'm going to be taking a position, because I really prefer to go into things that are slightly more misunderstood with a few more hairs on it, but the valuation is a lot lower, that I'm compensated for that. And if you want to find out what kind of stocks I'm interested in, don't forget to check out my marketplace. It's called Deep Value Returns. You're welcome to do a totally free trial to see if it suits you. And as I say, you know, it's not a place where I'm going to replace who you are as an investor. It's just, you know, I'm going to give you 1 or 2 ideas, and you're going to be like, okay, you know, I didn't think about that, or I haven't got the time or inclination to think about new stock ideas all the time. And if you just want to come and check out my marketplace, we've got a growing investment community where you can drop some messages in a chat board, and kind of people bounce the ideas off each other. So anyway, hope to see you soon. Bye.